134. You add 20 points onto that, so you'd be a buyer at 132.84. Don't want to complicate this a whole lot, but 132.84, somewhere right in there, you would be a buyer of that contract. Now it did go on down to, you know, a little bit lower. It actually got down to 132.60. As I said, you want to allow enough movement, maybe 20 points below that predicted low, and if it goes below that, you're going to get out. You know, this is a short-term intraday trading. You don't want to take the big loss, so you'd want to get out. And you know, that allows you to then get in the market not too far away from that predicted low, and then if the market moves on up, to ride the uptrend to the high side. Then you could exit when the market approached the predicted high. The predicted high mentioned 134.17. When you take 20 points away from that, you have an exit point 133.97, which is you know, right in this vicinity, right in here at 134, pretty close in there. Again, a gain of about a little bit more than 100 basis points. The other possibility, again, close, you know, exit at the close, you know, stay in and exit at the close. And again, the question of where is the close and what time is it and so forth. 134.36 was the actual close that, you know, the Euro FX contract showed. Now, the other possibility is you might be a little skittish about having your order sitting there and, you know, kind of, you know, being kind of out in the open without really knowing exactly which way the market is going. So you might want to let the, when you know, the market starts at this opening spot right here, you might want to just kind of wait around, see what happens. The market goes to the low, hits the low. You know, if you use the predicted low as your entry point, your limit order entry point, you know, you'd be in. But let's say that you decide you're going to wait. You're going to see what happens. Is it going to bounce up? There's a nut. So then you let the market sink towards that predicted low, and then it starts to rally. It starts to come back and goes through the open price right there, and then you can buy on the open. This is similar to what you might consider like the oops trade. I think Larry Williams made it popular, where the market starts at one place, goes in one direction, then oops, it made a mistake, and then goes back up through and rallies. It's the opening range breakout type of a trading strategy, and then moves to the upside, and you can get in on the breakout, the opening range breakout type of trading strategy to go long. Now, the question here is, how does this look when you look at an actual intraday chart? When you try to translate what you have here on an end-of-day type of chart with the indicators, with the, you know, all the clues being there, how do you trade it on the basis of what you're looking for when it comes to the chart itself, when you want to have something, you know, that you're looking at? And we're going to now go back to our PowerPoint presentation, and let's see if I can find it here. Okay. And okay, we're switching back here. Okay, Darla, I may need your help here because I seem to have lost exactly where I wanted to go. Okay, there we go. I got it. We got it back. Okay, we are now back to the PowerPoint presentation, and this is what it looks like when you look at a given day, when you look at what is going on the chart on the given day. This is on November 30th, the day we've been talking about, and we had a situation on this particular day where, you know, when we were talking about that, where we had the opening range breakout type of strategy is what we're thinking about now. On November the 30th, we had a initial open. When you can look at the chart here, and you can see that we had the open right in here. Now this is not, you know, exactly, you know, time-wise. Again, it's the 1700 time, at least in the central time zone, where we're using as the opening. What the opening period should be, you know, is subject to question. I like to use something that is approximately, again, this is an approximation, and it will depend a little bit on person to person, but the approximately between the open at 1700 and roughly, in my case, would be 2 or 3 a.m. That's when the European traders start to come on the scene, you know, which is a big Forex market center, and so you have kind of that as being an opening range. Now, there are things that happen sometimes that are in that range and outside that range, and so you can't, you know, definitively say, but one of the ways to trade on an opening range breakout situation, you had the, on November 30th, you had the high here, 133.60 at the end, and you had a predicted range here, right here, of or predicted low in this, or not a predicted low, a low of the range of 132.60, which is a 1% spread, which is a fairly wide spread. You like to be able to think that you might be able to capture a little bit of that, and remembering, you know, October 27th, anything could happen at any time, and you may get, you know, the possibility that would give you a big profit. Well, the vantage point predicted low was 132.64. So the vantage point predicted low that I mentioned on the other screen, you know, was very, very close to what the actual low turned out to be of that predicted range. If you faded the low, of course, I mentioned you would be buying a limit on the limit order at 132.84, and you would exit then, as we said before, at 133.97 if you were using that particular type of vantage point strategy. And if you are then looking at the opening range breakout type strategy, where you set that up here and you get the breakout, and this occurs at approximately or thereabouts around 7 a.m. or so, the market, after trading back and forth, shoots higher. Now, again, I think it was probably the announcement of some kind of central bank agreement. What prompted the move, you know, the actual cause for it, I don't know. All we know is that we had a lot of traders that got really excited and started to buy the market. So then the question becomes, how long do you want to stick this out? If you think that the market is going to go on up and you're a trend trader, fine, you know, you might want a long position, you might want to just ride it on up. But in the case of an intraday trader, you're probably more interested in doing what you can do with that day's profits and then not letting them get away. So we know, first of all, that when we were talking about the previous low that we had, when you get down to this range right in here, this 132, somewhere in there, we're approaching the previous low, and that's probably going to bring us some support. It's probably going to bounce us to the upside, and so that you don't want to, you know, take a position, a short position, going into a low when the support is there. And when you look at the various turns and the indicators that we were talking about, the bullish prospects, the last time that occurred, when you were looking at it in early October, that was about, you know, a move of about, I'd say 10 cents or so from low to high. That's $12,500 per contract for the FX futures contract in 18 days. And, you know, we don't know if that's going to repeat, and we don't know, you know, even if it's a possibility, but we're not making predictions, we're not making projections, but we're just thinking about where the market could go before the traders, all the traders, realize that there are a lot of problems that still exist in the Eurozone, and they may end up, you know, not being able to resolve those, or may end up with the crash. But once that market goes shooting up, we say, okay, let's take advantage of that situation. We'll put a profit target 1 cent higher of the breakout point. That comes from the width of this breakout, or the width of this opening range is 1 cent. You add 1 cent